Gold prices just took a hit, and it's not because of inflation, interest rates, or a central bank shock. It's because two of the most powerful economies on earth, the United States and the United Kingdom, just announced they're in talks for a major bilateral trade. President Trump, back in the spotlight, called it a full and comprehensive deal aimed at reshaping the economic relationship between the two allies. Now that sounds like good news. So why did gold fall? Well, markets don't just react to conflict, they react to certainty, and a high-level trade deal between two of the most stable and economically intertwined nations in the world signals a calming of waters, at least temporarily. The result? Investors dumped safe haven assets like gold and jumped back into risk. This drop might not be as meaningful as it looks, because if you dig into the history of U.S.-U.K. trade, the timeline of how these deals unfold, and the global forces still building behind the scenes, the real moves in gold may be just getting started. And to see where gold could actually be heading next, we need to look at what's quietly being negotiated behind closed doors, and why the next deal could send prices soaring. Gold prices dipped immediately after the announcement. Spot gold fell 0.7% to $3,342.2 per ounce, while US gold futures dropped 1.3% to $3,347.90. To some, that may sound like an overreaction, but in reality, this is how the market works. It prices in reduced fear. When two major economies start building bridges instead of barriers, the incentive to park money in hedges like gold weakens. But this trade deal isn't exactly shocking. The US and UK have always shared what politicians like to call a special relationship: military alliance, intelligence share, mutual financial. They've been stitched together for decades. So when two longtime allies float a new trade agreement, it's less about surprise and more about And here's the thing: even if this deal goes through, it won't have the same global ripple effect that a US-China or US-EU trade conflict. Investors know that. This was a short-term, knee-jerk reaction, not a full trend reversal. So if this drop in gold is just noise, where should you actually be looking? Start with Asia. China's central bank recently eased restrictions on gold import, a huge move. They're now allowing commercial banks to use foreign exchange reserves to boost gold buying. That could quietly put upward pressure on global demand, especially since China is already the world's largest consumer of gold. And then there's India. In April, demand for gold surged over 8% compared to last, driven by wedding season, renewed household savings. But beneath that surface lies growing geopolitical risk, border tensions with Pakistan, and internal economic challenges that could trigger another wave of gold accumulation as insurance. Now zoom out further. The future of gold prices hinges on a volatile mix of trade policy, economic signals, and geopolitical risk. And while the US-UK deal triggered a short-term dip, it's the deals we haven't seen yet that could shape where gold heads next. Take, for example, the possibility of a renewed trade pact between the US and China. If Trump were to reintroduce aggressive tariffs or limit tech exports to Beijing, we could see a massive wave of uncertainty hit global market. That kind of instability doesn't just send investors fleeing from equities. It usually drives gold straight up. After all, when global trust breaks down, gold becomes the fallback. On the flip side, if the US manages to pull off a broad multilateral deal with key allies in Europe or the Asia Pacific, something that boosts global trade and reduces long-term risks, gold could face continued downward pressure as investor appetite shifts to risk on assets. Then there's monetary policy. If inflation data comes in hot and the Federal Reserve is forced to raise rates aggressively, gold could stall or even decline further in the short. But if the economy weakens under that pressure and the Fed has to pivot back to rate cuts or stimulus, we could see a sharp rebound in gold, especially if that dovish pivot sparks fears of currency debasement. And don't forget central bank demand. Countries like China, Russia, and India have been stockpiling gold for years, and that trend hasn't stopped. In fact, China's central bank added nearly 225 tons in 2023 alone, and 2024 purchases are on track to match or exceed that. Continued accumulation at this scale adds a slow-burning floor under the gold market that most headlines completely overlook. So where does this leave us? The US-UK trade talks might have pulled the rug out from under gold for now, but this isn't a rug, it's a reset. Markets were looking for something to react to. They got it, but the bigger picture hasn't changed. We're still living in a world with unstable debt levels, geopolitical flashpoints, unpredictable central banks, and a monetary system under strain. And in that kind of world, gold isn't going away. It's just waiting for the next shock, the next round of uncertainty, the next move that makes investors question the future of their dollars, euros, and yen. So while this US-UK trade story might dominate the headlines today, don't let it distract you from the bigger storm clouds forming on the horizon, because when they break, gold will be one of the first places the money runs.